the very large borrowings in FY21 went through because of conditions which were driven by COVID. They will not repeat themselves, presumably, in FY22. Are we then in a structural sort of higher interest rate, steep yield curve kind of environment from here on?
Yeah. So this is an interesting question because fiscal policy. We previously spoke about how 2021 needs to be the year where the baton moves from monetary policy to fiscal policy. And fiscal policy has picked up the baton. Now, the question for monetary policy is, do you be complementary to fiscal policy, or do you become a substitute so that all guns are not blazing at the same time? I think this will have to be a very nimble approach. Last year, despite the high borrowing, the quantum of QE that the central bank had to do was much lower than anybody thought. Because remember, we said that India would run a current account surplus, and that current account surplus meant the private sector savings investment surplus was much larger and was able to accommodate that borrowing from the government. This year, both because the economy is recovering faster and because the fiscal deficit will be higher than we thought, we now project a current account deficit of about 1% of GDP. So now the conditions are the opposite, where we have an investment savings gap. Private sector savings will fall. That's a good thing because that means private demand is coming back in the system. But that means there is less private sector savings to absorb what's a higher borrowing number. What does that imply? I think two implications here. One is that, I think we'll have to get used to the fact that the equilibrium yields in the market will have to be higher. We can't expect that the yields that existed at the bottom of the slowdown, when you had so much precautionary savings from the private sector, will be the same when the economy is bouncing back sharply and private sector savings have fallen. So I think there has to be some healthy equilibrium adjustment to a new equilibrium, A. And B, I think the RBI's near-term focus will perhaps have to be to ensure that this move to the new equilibrium is non-disruptive and gradual. And I think the way one can think about that is that they already have a large quantum of liquidity. And the central bank began this year trying to slowly normalize liquidity. Now, the question is, how do you normalize liquidity, or how do you avoid adding liquidity while still supporting the government's borrowing program to avoid a big hardening of yields? And I think one kind of the most obvious approach would be to separate between stock and flow. There's a large existing stock of liquidity. If you can withdraw that stock, so for example, when the CRR normalization happens in March, about 1.5 trillion will be withdrawn. That allows the RBI then, at least in the near term, to do 1.5 trillion of open market operations in the next few months, such that the total quantum of liquidity hasn't changed from where we started the year. So similarly, I would expect that there'd be this a swap where they would withdraw liquidity, perhaps using term reverse repos and the CRR normalization, and substitute that with OMOs, or some support for government bonds in the coming months. So I would think that would be a way to balance this. Number two, at some point this year, we could expect to get into a bond index. So there'll be a new source of bond demand at that point in time. But the bottom line is, in the near term, I think it's understandable that monetary policy complement fiscal policy. We don't want too much of a tightening. But again, once the recovery gets hold, it's important that monetary policy become a substitute to fiscal policy. If fiscal is firing, monetary, having done a lot of work last year, needs to take a step back. We need to ensure that real rates don't remain negative forever. But again, Ira, I think that's a matter of timing. I think right now the imperative is just ensure financial conditions don't tighten too much on the back of this new fiscal path. And then as things stabilize, one can start normalizing down the road.
A couple of questions on liquidity. Sajjid, what is the normal or the steady state liquidity policy now? I'm genuinely confused because, even the last reviewed document from the RBI on liquidity said that in this corridor system, where the repo rate is the only target rate for the MPC, you have to maintain mild deficit or close to neutral. And then there was that one line saying that except if financial conditions warrant. But now, so at what point do we say that we need to move back to steady state, and what is that steady state? I'm genuinely confused.
Yeah, so we'll await clarity on what the steady state is, but I would expect that the movement, I think the RBI began the year with that. I think the reverse repo in January was meant to signal that there will be some gradual normalization of liquidity. But just as we don't expect, the fiscal deficit, big increase in the COVID year to be all reversed in 1 year, I think it's going to be a bit unrealistic to expect that all of this will go away in a few months. I think that will be maybe too much. So I would say, over the next 4 quarters, for example, or thereabouts, a gradual reduction of liquidity would be warranted. And the challenge is going to be, how do you do that while at the same time, providing enough space to backstop government borrowing and ensure that those yields don't go up? This is an art more than a science, but I would say we should give the central bank at least a year. Ultimately, what we want is the TREPS overnight rate, which is today trading at about 325, 10 basis points below the reverse repo. The objective should be to bring that back to the policy rate of 4%. Because if you believe inflation a year from now is going to be 4.5, and your overnight money market rate is close to 4%, then your real policy rates are zero, they're not negative, and we can live with that as the economy is recovering. Now, the interesting question is, how do you go from here to there? And the typical path that other central banks have followed is, again, I'm not advocating this immediately, I think this will happen over time, is you start narrowing the corridor. So the reverse repo, which is 335, at some point can move to 350. It can then move to 375. When the reverse repo starts moving up, you will find that automatically the money market rate will go from 325 closer to where the reverse repo is, say 375. So that should be the order. Now, once you get to that rate, then as you gradually withdraw liquidity and liquidity reaches a certain point, then you will find that money market rates start bouncing between the middle of the corridor and the bottom. So that would be my advocacy on how to do this in baby steps. But again, we have to be cognizant that I think the RBI's first job is to ensure that you don't get an excessive tightening of financial conditions on the back of this new fiscal path. We need to stabilize the bond market and then do this progressively, the narrowing of the corridor and liquidity withdrawal over the course, I would say, over a year.
They would have some leeway in ensuring that this process doesn't conflict with their inflation targeting mandate. Firstly, the headline number has come down, plus I think some of the nuances of the fiscal deficit that you spoke about may mean that they don't see this new fiscal path as hugely inflationary.
Yes, for 2 reasons. One is just because the signals that core inflation is giving us about the state of output gaps in the economy, right? So 2 things. One is headline inflation. We expect will go down to the 4% handle in January, which comes out in a few days. And we actually think inflation over the next 6 months is going to average close to 4.5%. So this gives the RBI time and space to do this in a non-disruptive manner, not be hurried by the inflation prints. I think that will give them some degrees of freedom. The other thing I think to look at is, again, core inflation. Don't be fooled by the year-on-year numbers, which are sticky and sluggish. Look at the momentum, and the momentum of core inflation has fallen from an annualized momentum of 6% to below 3%. That tells you that there is significant slack in the economy, which is why I think right now, the fact that there's a big fiscal thrust should not be particularly in the labor market. You can see it in core inflation. So I think at this point in time, any comparisons with 2010 are misplaced. Yes, at some point in time in the next couple of years, when things do pick up, the momentum of core inflation does pick up, we would need to reverse course. So right now, I think the RBI has the inflation prints in its favor, and it can normalize liquidity, I think, at a calibrated pace.